Hello and welcome back to Financial Freedom Hub. In today's video, we will talk about capital expenditures on a company's cash flow statement. By the end of our today's video, you will know what crucial information this row holds and how the world's richest investors can tell if the company in question can make them even richer or if they should keep away from it. The good news is that by the end of this video, you can do the same. You will be able to see clearly if a company is a safe investment that can make you rich and financially free, or you should keep away from it. So keep watching. Before we start, we would like to remind you that we have published playlists about how to read and understand any company's income statement, balance sheet, and cash flow statement. And you might want to check them out to learn all the secrets of the world's greatest investors like Warren Buffett. You might also want to subscribe to our channel so you don't lose it among millions of other great channels. So, let's get started. Capital expenditure is a cash outflow into a company's long-term assets. Just to remind you, long-term assets are those that the company plans to own or control for longer than 1 year. These assets are expensed during their useful life through depreciation and amortization on income statement. They include things like property, plants, equipment, machinery, and such intangibles like patents. Capital expenditures are recorded in cash flow statement under the category of investment activities. It's important for an investor to know that not all companies are created equal when it comes to capital expenditures. Some companies need to spend a lot of money on capital expenditures just to stay alive. If a company shows high capital expenditure over a long period, it usually indicates that they operate in a highly competitive industry, and they constantly need to upgrade their production line and invest in new technologies. Take for example a mobile communications services provider, T-Mobile US, TMUS, and compare its capital expenditure figures to their net earnings. As you can see, their capital expenditures is constantly higher than their net income. If the company's net income cannot cover its capital expenditures, it's fair to ask, where does all this extra cash come from? That's right, you guessed it, it comes from loans and selling tons of debt to the public, which in turn adds more debt to the balance sheet and increases future interest payments. This is why, when you see high capital expenditure over a long period of time, you can be sure that it starts to eat into the company's earnings. Now, let's take another example. VF Corporation, VFC, the owner of brands like North Face, Timberland, Smartwool, Icebreaker, Vans, and others. Let's have a look at their cash flow statement for recent 10-year period, and we can see that the rate of capital expenditure to net earnings stays, with occasional exceptions, in the range of 21 to 49%. This indicates that the company does not need to spend huge amounts of money to keep their production running, and that the company can cover their capital expenditures from their own profits. Now, to make it even easier, we simply take the total amount of the company's capital expenditures during the last 10-year period and divide the amount with the total amount of earnings for the same period, and we get a pretty good idea if the business might have a competitive advantage or not. In case of our examples above, the results would be as follows. T-Mobile US Incorporated, TMUS, spends 258% of their earnings to run their business, while VF Corporation, VFC, spends about 40%. So, in conclusion, here is another secret rule from the world's smartest investors for you to follow. It goes like this. Companies that have some kind of competitive advantage over their rivals don't have to spend more than 50% of their net earnings to maintain their production. Please keep in mind, however, that the purpose of this video is not to provide investment advice. Capital expenditure in isolation is not enough to make investment decisions. It can only give you a good head start to decide if the company in question is worth the time and effort of implementing further due diligence. If you found this video useful, please give it a like and share it with your friends. Thank you for watching.